Good evening, this is Chris Ream and it's Life Insurance Guy Live. I decided that I'm going to do a podcast every week, go on Facebook Live every week, that is, and just answer the 5 or 10 most interesting questions that I get during the week. As a life insurance guy, I get to work with a lot of really interesting people, mostly business owners, but really everyone in all walks of life. And they come up with some pretty interesting questions sometimes. Today I have Carmen Feinberg with me here in the studio, and she's going to feed me some of these questions that we wrote down that have come up over the last week or so. And we're just going to go live and answer your questions. We've also got the capability to take your phone calls. So if you're watching and you want to dial in and ask a question about life insurance, the number is 954-210-5413. Anything goes. We can play Stump the Chump, call up, ask as technical or ask what you want, and I'll answer it. So thank you very much. The first question that I wanted to talk about that I get a lot, Carmen, is why do I have to take a medical exam when I'm applying for insurance? So why don't you ask me that question?
All right. Why do you have to take a medical exam when you're applying for insurance?
I'm glad you asked me that. Well, it's because that they don't trust us to answer the questions truthfully and honestly. So most people that want to buy insurance, like if I get a phone call from somebody and they say, I want to buy some life insurance, that tells me that they're probably uninsurable because they know that they've got some medical condition and that's the reason they want insurance. So the medical exam is a way for the insurance company to fairly evaluate someone's level of health, and so that they can price the policy appropriately.
Okay. So what would be a reason why an insurance company would deny you for insurance?
So there's a whole long list of reasons, and some of them like you wouldn't even believe. So you can have a little bit of skin cancer, even like a non-melanoma type of skin cancer, and you can be like a postponed for a year. You just get you get a little bit of sugar in your urine just from like a pre-diabetes, and guess what? You're declined for insurance.
Wow. So can you prepare? Is there any way you can study to make sure that you would pass?
Well, you can, and believe it or not, the easiest way is just go to the doctor on a regular basis. Because here's something that's really interesting. Let's talk about how to get accepted. So if someone has high cholesterol, like over 250, whatever the units are, so if your cholesterol is over 250 or over 260, you're in danger of getting rated. However, if you go to the doctor, they put you on cholesterol medications. Let's say you take a statin, and let's say your cholesterol now is down in the 200 to 210 range. Mm-hmm. Guess what? You're not rated anymore. So if you're on cholesterol medication and your cholesterol values are in the range of like a normal healthy person, right, you get the same rating.
So as long as you manage the illness or the situation that you have, and you have the doctor showing that you are doing that with the doctor, then you have a better chance of getting approved, correct?
Yeah, that's right. So what is the insurance company evaluating? They want to know how long you're going to live. They want to know, more accurately, they want to know how long you're going to pay those premiums.
Right.
That's what they want. And so what scares insurance companies? That is the unknown. So if you've got some condition that they don't know, they're going to decline you. But they know there's enough history now with the cholesterol medications that they know if you're taking those medications, you have a normal life expectancy. You treat it as if you're a vegan yoga teacher.
So it's really just an algorithm for them to make a decision based on the data that you provide them. So more data is better.
Well, that's another great question. And what I tell my clients, when they're applying for insurance, don't go back to the doctor unless it's an emergency, because you can only break even by going to the doctor in our business. So by going to the doctor, they may find something wrong, and that could obviously cause us a problem in trying to get a policy issued. So in a very real way, more is not always better.
Right.
Yep.
So basically stay healthy as you can and take care of yourself. So it wouldn't do me any good that I lose weight right before I apply for insurance or something like that. That wouldn't work?
It does you a little bit of good, but there's a question on every app. There's a question on every application that says, have you gained or lost more than 10 pounds in the last year? And if you have lost a significant amount of weight, you can qualify for a better rating class, but you have to keep that weight off for a year for it to count.
Okay. All right. So I want to switch.
But how do they know that? How do they know if you kept it off for a year? That's the awful question that people ask.
But I think that from what you said earlier, I bet it's based on what the doctor says in those doctor visits. So where more is not always better.
That's right. So what do they do every time you go to the doctor?
They weigh you.
They weigh you, and it's in your records. And as a part of the application process, they're going to ask you your health questions. You have to answer completely and truthfully. Then you're going to have a medical exam where the paramedical comes out to your home and does blood and urine, weighs you, takes an EKG, your blood pressure sometimes. And then they're going to collect your medical records, and they're going to they want to see everything agree. If everything agrees, then they're confident they know how long you're going to live, and they can quote the policy appropriately.
And if not, and it doesn't agree, then they'll just deny you.
Not always deny you, but it definitely causes me as your advocate a lot of trouble. So you have to tell me in advance all the...
So you're like a lawyer.
Well,
you have to tell you the truth.
Yeah, you have to. I can do my best job for you to advocate with these insurance companies to get you the best policy that you... And there's no game playing. The state laws and so forth, they have their standards. If you meet their standards, that's the rating class that you get. So, but if you lie, you try to game the system, they don't like that.
Right.
So if you're lying about this, what else are you lying about? And either they rate you, or they decline you, or they just decline to offer you coverage.
Okay.
Yeah.
So let's switch gears completely. Another question that came up this week is, what happens to life insurance in a divorce?
That's a great question. Life insurance in a divorce is treated just like any other property. So once you buy a policy, it's your property, and you can buy it, you can sell a policy, you can give it away, and it's a marital asset. So if it's a cash value policy, a lot of times they will split that policy. They'll actually sometimes the insurance company will let you create two policies out of it.
Oh.
Sometimes though, let's say it's a cash value policy and it's got $25,000 of cash value. Well, spouse A is going to get that, and then spouse B is going to get the $25,000 in the investment account.
I got you. What about the children? Do you, if you have a divorce, what should you do with your children's life insurance policies?
Well, that's the good part about divorce. Well, there is a good part. Almost always, both parents have their kids' best interest in mind. So you don't want to name a child the beneficiary of a policy, because then the court's going to have to appoint a guardian. But usually, if there's a divorce, you would have a trust, and almost always the ex-spouse would be the person who's going to care most about the kids anyway. So if you and I were married and got divorced, I'd still want you to be the trustee of my kid's policy. Now, if I bought $1 million policy and I died, I wouldn't want you to spend it. You're my ex-wife. No, but I wanted that in a trust, and I'm happy with you being the trustee because I know you're going to have the best interest of our kids together. Now, the other thing is, in a divorce, the judge often orders to have life insurance to back up the as part of the divorce decree or the divorce settlement agreement. Because if I owe alimony and I die, that's not so good. So a lot of times they will make you buy life insurance to that would cover up your alimony or cover up the the part of the divorce settlement is the.
I've heard of that.
Yeah.
Yep. Mm-hmm. So, what's the best way to get a lower rate on life insurance? Do you go to multiple agents? Do you just keep one agent? What do you do? Do you shop around?
That's a great question, and most people don't believe when I tell them that you have to pick one agent. You have to pick one agent, and then let that agent or let that broker, more specifically a broker, because an agent represents the insurance company, a broker represents the client. So you want a good insurance broker who's going to take that case to multiple carriers, and they're going to present the medical records and your questions and the whole application in the best light possible. And then the carriers are going to make offers. Where you don't win is having, I have every once in a while, maybe once or twice a year, I have a client that thinks they're smart. They're usually, I don't want to stereotype people, but they're usually, in a business where they get beat up a lot, and maybe like a car dealer, or they're in the construction business.
Yep.
Where every contract they have to go out and shop 5 different ways. So those are the type of people that get quotes from me. I do a lot of work, and and I present their case to a couple of different companies, and I get proposals, and they think, oh, I'm going to show Chris, I'm going to go out and get another agent, and we'll put them against each other. Well, in the life insurance world, it doesn't work because there's no game playing, and the insurance companies get confused. If they see two different applications for the same person, they get scared.
Right.
Why is this person trying to buy two policies?
Right.
And because of the financial underwriting that has to go into it, they oftentimes they won't issue two policies for the same amount.
Yep. I'm familiar with that. So really, I think that what you should look at it as is that you're having the carriers are the ones that are fighting for your business, not the
Yes.
agents or the brokers.
That's exactly right. And when you're talking about the world of the high net worth, and we're applying for 10 or 20 or sometimes even 30 or 40 million dollars of insurance, if you have more than one broker representing you, you're absolutely hurting the chances of getting the policy issued, especially on a timely basis. They're going to go down to the end of every street, dead end, and investigate why are you coming to market without a comprehensive plan.
Right. So speaking of going to market, how often should someone be going to market and looking at competitive policies and rates and things like that?
So that's a great question. And there's something like $27 trillion worth of life insurance in force today in the United States of America. Most of those policies are wrong. And by that, I mean they have the wrong funding, they're with the wrong carrier, they're with the wrong underwriting class, they might have the wrong beneficiary, they might have the wrong owner. And all these policies are out there wrong because nobody is looking at them, nobody is reviewing them. 50% of all policy owners don't even have an agent or a broker anymore because that person quit the business.
Wow.
It's shocking. Think about it as if you bought any other piece of property, an investment. Let's say you bought a warehouse. Wouldn't you hire a property manager to manage that asset for you?
Right.
So somebody should be looking at your life insurance. It's not to buy it and stick it in a drawer and forget about it. And so 50 or 60% of my time I spend cleaning up other people's messes. And it's a good opportunity for me because maybe half of that time I'm able to replace that policy with something better for my client. And then the insurance company pays me for solving that problem for them.
Right.
And the other half of the time, I'm finding ways for them to improve that policy's performance, maybe take some of the risk off the table, or better manage the premiums, or get the beneficiary right. Oh, that's another great question. What about if you get divorced and you leave your ex-wife as the beneficiary of your policy? Well, let's answer that another day. But so everybody should review their life insurance at least every 3 years. And the older you get and the bigger the policy, maybe every year or every 2 years.
And do you do that for your clients?
Absolutely. Well, my clients I've only been doing this for 11 years. So the first 11 years of a policy, there's not a lot of review that's required. However, here we are today at the end of September of 2019, and the government just came out with new mortality tables.
Oh.
Were you aware of that?
No, I was not.
You know what a mortality table is?
I would imagine it is how long, considering how long you're going to live and how long Americans are living.
So the government just came out in 2017 with the new mortality tables where they say for each demographic, each male, each female of each age, what the life expectancy is.
Right.
So do you think life expectancies are going up or down?
I've read recently that they're going down, right? Aren't they going down just a little bit?
They're going up.
Oh, they're going up.
Yep, they're going up. So what does that mean for the life insurance buyer?
That means you're going to live longer.
And the prices go up or down?
The prices go up? No, go down?
Yeah.
As the longer you live.
The longer you live, the more premiums you pay, the less I have to charge you every year.
Oh, okay. But if you wait to get an insurance policy when you're older, then they go up, right?
Oh, yeah. So the price of the insurance goes up every year. That's another great reason to have your policy reviewed, is that every insurance carrier in America now is required by law by January 1st of 2020, they have to reprice all of their cost of insurance. That means reprice all of their policies and bring them in line with the 2017 mortality tables. So for most people...
2017?
Yeah, it takes them 4
Wow.
years to implement this.
Wow, okay.
So even though the mortality tables came out in 2017, government efficiency. Wait until the January 1 of 2020 until they have to reprice their products.
Wow. Okay.
Now, there is one demographic in America where life expectancy has gone down dramatically.
I thought that was a younger year, right? The teenage or the
You're
20s?
on the right track.
Yeah, okay.
But that's not right.
All right.
It's because of the opioid crisis.
Right. That's what I read.
But it's really more like middle-aged women who are
Oh.
dying the most because of the opioid crisis.
Wow.
Now you know.
Now you know. All right. So let's, how can I tell how much life insurance that I can afford or should I get?
Well, there's a whole bunch of approaches for that. The easiest way, well, I like to ask the question. I ask my clients, would anybody that you care about suffer financially if you were to die prematurely? Because really, isn't that the real reason that you buy life insurance? Is if I died prematurely, would anybody I care about suffer? Well, yeah, they're going to lose all my income.
Right.
They're going to lose my stewardship of my assets, and I'm going to manage and grow these over the rest of my life. So yeah, there's a big financial impact if I die to my family. So that's why I buy insurance, to replace that amount. So that's the most sophisticated way of calculating how much insurance you should buy, is what's the whole economic impact to the world, or more like your family.
Right.
if you're
Your
not here.
world. Right.
Right. Then the other ways are just figure, what does it take to support your lifestyle? Let's say it takes, $2,000, $4,000, $6,000 a month to pay your mortgage, send your kids to school, buy your food, shoes, and clothing. Well, then you just figure out what's a lump sum that you would need if you died that would provide for that much cash flow over the next 25 or 30 years, and you can back into it.
For your family.
For your family.
Right. Do you help your clients do those calculations? Or?
Yeah, I've got software that does all that.
Okay.
And it produces a really nice presentation, because one thing I learned from my mentor, Bruce Udell, maybe he's watching because he actually follows his Facebook page.
Maybe he'll call.
Maybe he'll call in.
Yeah.
Is that people tend to believe their most trusted advisor. Mm-hmm. So who is their most trusted advisor?
Well, I know the answer to that.
Okay.
Themselves.
That's right. The answer is themselves. So people listen to their most trusted advisor, themselves. So I like to ask them questions, and then when they answer it, then they can't argue with me. So I just ask them, how much does it take to support your lifestyle?
Right.
Punch that into the computer, and then it says, okay, you should buy $2.5 million of insurance. And then it's their idea, not my idea.
Right. Absolutely.
Yeah.
So here's some things that came up this week. What is the return of premium feature? Never heard of that.
Yeah. So I guess on the most basic level, it's a gimmick. So
Okay, that's an honest answer.
So you pay into this policy.
Okay.
Let's say you pay $1,000 a year for this term policy, and it's for 20 years. Mm-hmm. So after 20 years, at $1,000 a year, how much have you paid in?
20,000.
So return of premium rider says we'll give you your $20,000 back at the end of the 20 years.
Okay.
So that sounds pretty good.
Right.
Right? And however, the pricing of the premiums and the amount of the insurance that you're buying. So if I said, give me $1,000 a year for 20 years, and at the end of 20 years, I'll give you $20,000 back. Is that a good deal?
Yes.
It is, but who got to invest that money? All those.
They got to invest the money,
Yeah.
not you. Right.
Right. So if that's a return of premium policy, and that's the terms, and you ask me, is that a good deal or not? I'd say, I don't know. How much death benefit are you buying?
Right. And I think it depends on your needs of the insurance, the policy itself.
Sure,
right?
but we're saying the same thing. So, is it mathematically a good deal? Depends on, does the $1,000 a year buy you $10,000 of insurance, or does it buy you $1 million of insurance?
Right. So what you're saying is don't let the premium back cloud your judgment on what you're purchasing in the first place.
I'd say do the math, because there are designs where a return of premium rider really makes sense, and it allows us to do some things with the design of the policy that really, where the math really does work.
So something like that, how would your clients know about those technicalities and those things? How do you present that to them? It's by person, individual,
Yeah.
customized?
Yeah, ours is a It's definitely a one-on-one, belly-to-belly business. And yeah, my style and the styles of the best in my business, in my profession, it's here's your options. Here's the good, here's the bad, here's the costs, here's the risks, here's the benefits, here's the detriments. What do you want to do?
Right.
And that's really the way that
So when you're going through that, and you're talking to the different carriers as the broker representing your clients, how do you tell your clients how is the premium assessed from the different carriers, and what is the difference between one carrier and another?
Well, one of those questions that I prepared you for, you're asking the kind of the same one, but the one that I think we'll tie into is this one about, because this came up actually today. I was speaking with an attorney. I think he's around 71 years old, and he had insurance through the Florida Bar.
Okay.
So they have, just like the Florida Bar and the Florida Institute of CPAs have an affiliate insurance program. And they have really affordable, good term rates. And I love it when an attorney or CPA says, I don't need any insurance, I don't need to talk to you, I get it from the AICPA, or I get it from the Florida Institute of CPAs, or I get mine through the bar. And what surprises them is when I say, I think you should buy all you can get from the bar, buy all that they will sell you, because it is a very good deal.
Right.
But where they get you, and your question was, how is the premium determined, right? So how can the bar and the CPA Association offer a lower premium? Now, those CSO mortality tables just came out, and all these carriers are repricing their products. So why are any of the carriers have different prices? That's a really good question.
Right.
I'll tell you why. It's because they think they know more than the government about how long you're going to live.
Wow.
Each carrier has their own underwriting guidelines and their own actuaries that are predicting how long people are going to live.
Really? So regardless of what the government tables are, they have their own calculations.
Yeah, what the 2017 tables tell you is the most you can charge for the insurance.
Aye, gotcha.
And every carrier out there tries to charge less and still make a profit.
Right.
Okay, so now let's come back to the professional associations, like the attorneys, the CPAs, the engineers, they all have it. So they have really cheap rates. How do they do that? Do they know more about mortality than the insurance companies?
Or do CPAs live longer and healthier? What about lawyers? No.
Not,
Yeah.
So why is that how can they charge less? Aha, there's another factor.
Oh my gosh.
The factor is what's called the, I forgot what it's called. It's called the persistency factor.
Okay.
That is how many people are going to buy a policy and then not pay the premium next year and let it lapse.
Oh.
And so they know that the lawyers and the CPAs, they know that most people are not going to keep that insurance in force until they're old enough, until past their life expectancy. So
Right.
they know, I would bet.
So basically they're betting that they're getting all that premium when they're young.
Right.
And they're not going to have any claims,
Correct.
let's say, against it. So they can offer a lower rate because of that.
I'm going to come back on my next Facebook Live with real statistics about what percentage of term insurance policies actually pay out. But I believe it's something like 1 or 2%.
Wow.
I would bet that the professional association issued policies are less than 1% that ever pay out. And they hedge their bets.
Right.
So I'm going to tell you what's the dirty, dark secret about how these guys do it, is that they charge you a very low rate. Let's say they're charging you $1,000 a year to buy $1 million of insurance. And you're just paying that premium every year. This is a good deal. I'm very happy I got this. And then you turn 65. And it's the same price. Okay, happy to pay that $1,000. But what they don't really make a big effort to tell you is that your death benefit just went down.
Oh.
So they're very sneaky. They keep you the same premium and they lower the death benefit. Now
Don't they have to disclose that to
it's
you?
in the contract.
Oh.
And
there's a small print.
they probably send you a letter, but it's hard to read.
Right.
Most people don't understand it. And as a professional who is reviewing these contracts, these policies, and trying to say to the CPA, well, if you want this policy coverage to last until you're 75 or 80. How do we compare that? Because the same premium's getting you a lower death. It's just a little more math.
Right.
But that's how they hedge their bets. And I think these people should be, called out for this, because most people don't realize they're paying the same premium and they're getting a lower death benefit.
So it seems to me that it's quite complicated in some instances, and that's why your clients need someone on their behalf as the broker.
Yeah, absolutely. I think as we wrap up today, that's like a really important message, is that you have to find somebody that you trust.
Yeah.
And let them go to work for you.
And that's a professional in the field that knows what they're doing.
Yes. So there's a quote, I think it was the founder of RCA or something like that. He said, the problem in modern business isn't the crook. It's the honest guy who doesn't know what he's doing. And sad to say, I think in my business, there's a lot of honest, hardworking life insurance guys who don't know what they're doing.
Right.
And there's some crooks, but
right.
That's like another story. So yes, find a professional, put them to work, and you just have to find somebody that you trust and respect, and that'll do a good job representing you. Well, thank you today for coming in,
Thank
Carmen.
you.
I really appreciate it on this inaugural Life Insurance Guy Live podcast. I want to thank Broadcast Beat Studios. So my friend Ryan Salazar has built this amazing studio here in Oakland Park, Florida, and unbelievable world-class capabilities, satellite
Beautiful.
uplinks, podcast studios, television, what do you call those? The green screens and the control rooms. Unbelievable. So send me a private message if you want an introduction to Ryan, and we'll get you a tour of this place. So this is Chris Ream, and for Carmen Feinberg, I want to say thank you for watching our first Facebook Live podcast. And coming to you live from Broadcast Beat Studios in Oakland Park, Florida, this is Chris Ream. Good night.